Thank you, Marty. Really appreciate it. Hi, everyone. Thank you for hanging in. Love being the last panel of the day. Nothing like that. We're the only ones between you and the bar.
No, there's one more speaker after you.
Oh, one more. Okay. Well, close, but he'll be a short one. So my name is Rapkin. I'm with Akerman. I chair the real estate department for the firm nationwide. We're a firm of about 100, or we're a firm of about 750 or so attorneys total, about 170 or so of which are in the real estate group. All asset classes, all food groups, everywhere, anywhere, up and down the capital stack. Thank you for everyone who came today. Really appreciate it. Thank you to Neeson Kasdan and Marty Sakata for arranging us to host today. Really appreciate it. First thing we're going to do, just have self-introductions of our panelists. I'm going to go in alphabetical order, talk about what they do, maybe one or two representative projects and what their outlook might be for 2023, which is what our panel is. So first I'm going to turn it over to Robert Mason with Mason Capital.
Hello, it's great to be here. Thank you for Akerman for hosting, and Marty, as always, thank you for putting on such great events. My name's Robert Mason. I'm from Atlanta. Have been working in real estate for about 25 years. My family started a real estate investment business in the early 80s when we sold our peach farm. So kind of grew up in the business, worked outside of our family's business for most of my career, started with C.B. Richard Ellis, then went to Wharton, which has been mentioned a few times here today. Moved to Chicago and worked with Hines, and then moved back to Atlanta and headed acquisitions for the Southeast region with Lincoln Property Company. I left Lincoln Property Company to basically take over our family business, which has morphed and changed over the years. We've done about 100 projects across the southeastern United States, mostly all asset types, all different acquisitions, development, all kind of market cycles. So it's been fun to sort of be in real estate as a career and watch it. In terms of what we're focused on now, I'm partnering with some institutional partners, Eileen Murray, who was the former co-CEO of Bridgewater, and that just stepped down in July as the chair of FINRA, and another partner out of Europe, who was running a 4 billion euro fund for Blackstone. So we are raising money in Europe in large part to do sort of ESG themed real estate here in the United States. And we're asset agnostic. Unlike a lot of other folks, we're not just apartments or just industrial. We're sort of looking at everything with an idea of placemaking, really quality assets in phenomenal locations. That's what we're about.
Thank you, Robert. Next, again, going in alphabetical order, Neil McKinnon, who's on Zoom today, is President and CEO of Prana Investments. Neil, you want to tell us about what you do?
Sure. Thanks, Eric. And as always, thanks, Marty, for the opportunity to talk to your group. I'm President and CEO of Prana Investments, and we're an affordable housing owner operator. We do rent-regulated apartments in Los Angeles and New York City. We've been doing it for about 30 years. I'm another Wharton grad. I joined the firm in 1996 to build up the infrastructure of the investment management business. And we've had 26 completed funds, have 8 active funds today. Our focus is buying, rehabilitating, and preserving affordable housing in our markets. And we view it as a contrarian play to a lot of the other more mainstream real estate. We've done well in downturns, and we're not sure what 2023 holds, but based on what's happened in 2022, we think it's going to be a great opportunity for us. Our best performing funds in the past have been coming out of recessions. So 2011, 12, 13 were a great time period to invest with us. And we'll talk a little bit later about some of the other elements that go into investing in rent-regulated real estate. But again, I appreciate being on the panel today.
Thanks, Neil. Next, Onic Palandjian, who's a partner with Group RMC, and I think I heard as I was walking up in Greece right now, where it's nighttime.
That is correct. Thank you very much for having me. Thank you all. Similarly to Neil, we're also contrarian investors. We've been investing in real estate for the past 36 years, starting after the savings and loans crisis, buying apartments and multifamily in Houston. After that event, most recently we've been focusing on office properties. Again, being contrarian in office, so we go typically to the Midwest and southern United States. We own 21 million square feet across 14 different states, 211 properties, representing a little bit over $2.5 billion in assets. And I want to echo the sentiments that these times, we're not going to let them go to waste. We're going to take advantage of these fantastic opportunities that are before us, and happy to explain what we do in a minute.
Terrific. Thank you, Onic. And lastly, we have Phoebe Van Tran with Infinity Capital Lending.
Good afternoon, everyone. Thank you for Marty's for the opportunities to be here, and also share with you about Infinity Capital Lending and what we do and how we can help build value to your portfolio and what you're doing. So I came to the United States at age 16 and been working in different industry from insurance, banking, and mortgage. And since I started mortgage lending industry and worked for 6 or 7 years for a company, I love mortgage and lending is my passion. And so me and my business partner, Eric Avila, we co-found Infinity Capital Lending. And what we do is we are commercial real estate capital advisory firm that build capital stack and provide creative capital solutions to real estate investors and developers. And with a diverse network of domestic and international capital providers that we're currently working with, alongside with comprehensive knowledge of the capital markets that our team are building, we are consistently deliver executable advice and customized financing solution on every large-scale project, usually and regardless of the complexity. And our focus is on development projects of at least $20 million above. And for our pipeline, our average size, project size for our pipeline is range between 20 million up to 300 millions. And we also work with multiple private trust funds and employ those funds into bridge loan, bridge equity partners, and short-term loan for commercial real estate developments, ground-up construction, redevelopments, and repurpose. For example, deals that the deals that on our pipeline are majority office building, hotel, shopping mall, and a lot of we've seen lately are the repurposing of hotel into assisted senior living facilities, or residential, or repurpose retail into industrial warehouses. So those are what we do.
Terrific. Thanks, Phoebe. And in fact, I'm going to stay with you. I would like you to talk about what trends you think will impact commercial real estate industry, that have already started and will continue over the next year to 2 years to 3 years. What are you thinking about?
Sure, would be happy to share. So the economy is moving quickly, and of course we see pandemic continue to shape the future of our home, travel, retail, and office. And of course, quality of life and affordability plays a big role in where people choose to live. So what we're seeing is supply chain disruption can also affect the supply of new properties with construction delay and impact the commercial real estate demand by increasing the need for a warehouse and other industrial spaces. We do continue to see these impact for the next 2 or 3 years. And as remote working has boomed since the pandemic, we have seen a lot of companies downsizing their office space, and many hotels and malls have been struggling with low occupancy ratio between 30 to 40% on average. And we do see this trend as a great investment opportunities for expanding financing activity in commercial redevelopments and repurpose in response to these affordable housing crisis. So on our pipeline, the deal flow that we're getting from developer proposal has been office space into a multi-family conversion, mixed use, and hotel into a senior living facility or condo or multi-family conversion. Another thing that I want to highlight that we've seen the trend, and actually the main focus is the low carbon to net zero strategy continue to be the key future component for commercial real estate developments. The ESG integration in commercial real estate development, I do see the future main focus by increasing the energy efficiency in the building developments, sourcing renewable energy, and also engaging with affiliate ESG partner vendors in these ground-up construction, development, and repurpose. We do that by focusing on reducing energy consumption through these certified green smart building designs. Lastly, like we also think that we should create incentive for developers for accelerating their decarbonization of housing industry. For example, high quality prefabricated home made from environmental friendly material with the goal of lowering emissions. This will also solve the supply chain issue with brick model traditional constructions.
Terrific, thanks. Robert, I want to go back to you. You mentioned in your introduction about that you're asset class agnostic and even maybe geography agnostic. I'd like you to talk about why you think that's a good approach for you and your company.
Great question. We focus on the Sun Belt, and we're following the demographics, just watching people move. Florida, Texas, and Arizona have just exploded in growth. And interestingly, California, for the first time in its history, is shrinking in population, which is unusual. But we've watched New York, LA, Chicago, and some other gateway cities start to lose population because people are migrating to the Sun Belt. And then Texas, again, kind of the main cities in Texas, Florida, and Arizona have been the biggest beneficiaries. So we're focused on those cities. I've been very fortunate to work with Lincoln Property Company almost exclusively. They're our main partner in terms of development and operations, leasing management, et cetera. They're the largest privately held developer in the United States. They do essentially all asset classes except hotels. So we are working with Lincoln now. We're locking down about a $10 billion pipeline in some of the main Sunbelt cities, where we'll and I want to echo what was just said about greener, cleaner buildings. We're seeing people move into supply constrained markets where there's no room. They're coming from markets like California, New York, where they want high quality real estate that maybe doesn't exist. So we're trying to either buy it, retrofit, but when we can't do that, we'll build it. So we're controlling some key sites to try to do that. And when we're placemaking, we're not just focused on apartments. We're trying to build apartments, again, that are green and clean, that are walkable environments where there's office, there's hotel, there's retail, kind of all right there. When I look at Atlanta, where I'm from, Avalon was one of the most successful projects in Atlanta history. So we're looking to replicate that in some other cities that don't really have it yet.
Excellent. Thanks so much, Robert. Onic, I want to turn back to you. Also really glad to hear the optimism coming from several panelists. Without mentioning names, there was one or two in particular this morning that were quite pessimistic on the economy. I happen to agree that there's a lot of cause for very interesting opportunities that people will be looking at. So Onic, I wanted to go to you to talk about contrarian, in particular office investing in the Midwest and South. So I'd like to ask how you kind of secure your cap rates on projects and what you might be looking at and interested in, and how that portfolio fared during the pandemic.
Thank you. Thank you so much for the question. We are very, very peculiar and we have very strict investment criteria. So we buy at very big discounts to replacement cost. Just to give you an idea, we bought the tower that's right next to me, the Bank of America tower in Jacksonville, Florida, for $108 per square foot. And that's a huge discount to replacement cost. I mean, it's literally buying it at 20 cents of a dollar. So you can imagine that, you know, these prices are the result of fear. We feel that the rhetoric against office is overdone. At the same time, a number of office buildings have or will be converted into residential, so they're going off the market. There is also no new construction in the areas that we find and we purchase assets. And again, I have to say we purchase fantastic assets, but from distressed sellers. Hence, we buy at these very big discounts. And last but not least, we don't just buy the buildings, we have the cash reserves to do the necessary capital expenditures to bring these buildings to, you know, where they should be. Let's call it to their former glory. And we create amenities that are very much sought after by companies that are looking to go back to the office. And there's a definite flight to quality. So a lot of these companies are going and, you know, if they were occupying big buildings, now they're looking for Class A buildings. By making these spaces modern, fresh, and by adding these amenities that didn't exist, we increase occupancy, and hence we might be buying with a 9 or a 10 cap rate going in, but it ends up being a 13 or 14 cap project. So these are the kind of projects we're looking for, and we're very happy to report that they do exist in this environment of fear.
Thanks, Onic. Really, really interesting approach. Neil, and especially because I think most of today's speakers, panelists, participants aren't in the rent-regulated space as you are. So I'd like to for you to talk about why investors might be interested and should be interested in the rent-regulated real estate market.
Yeah, thanks. Thanks, Eric. For us, similar to what Onic's doing in the office space, you know, we're buying existing properties at a significant discount to replacement costs. So, you know, we're paying $150,000, $200,000 a unit in markets, Los Angeles and New York, where we invest, where the replacement cost is $600,000, $800,000, $1 million for allegedly affordable housing. And we're in a time where housing, generally speaking, and certainly affordable housing, is a major issue in every city and town in the United States. So we've been comfortable in the rent-regulated space because we have the teams on the ground in Los Angeles and New York to make it work. It's a highly regulated space. It keeps away. We're buying buildings that are sort of $2 to $10 million in size, all in a fund structure. That means most institutional investors are not in play here, and conversely, the smaller investors, the buildings are too large and the regulatory landscape too difficult for them to manage. So it's a very inefficient market. So we're able to buy buildings effectively, manage them well. Again, I want to note that one of the things that I think we do very well, and one of the reasons we've been able to be in business for 30 years, is we're very focused on the tenants and what they need in these buildings. And by and large, people in our markets don't invest in the properties. We invest in the properties. We have sufficient funds when we buy a property to replace the boiler, improve the security and fire and life safety systems, make things better for the the tenants all the way around. And in the rent regulated space, we're buying rent rolls that are anywhere from 70 to 90% of market rent. Over time, there's a disconnect between market rents and the in-place rents. And there are methods, though, to raise the rents in the rent regulated space. And that includes the annual mandated increases in each market. In LA, that's 3 to 5% per year. In New York, it's 3.25% to 5%. Then you can also pass through your capital expenditures. There's an amortization component that works to increase the tenant rents for any capital improvements you do. And then finally, when you get a vacancy, you can increase the rents at that point in time too. So we've traditionally been able to raise rents in all market cycles. We've never had a down year in residential rents in the 30 years we've been in business. Our rents generally are about 200 or 300 basis points above inflation, which will likely be a key issue in the next few years here. So we feel like we're in a market that represents a pretty defensive position as far as real estate goes. So we're buying well, we're managing, and then selectively looking to exit when the cycle is right and when we've been able to improve the cash flow on the property.
Thanks. I just want to follow up on one thing that you said that your rents are ahead of inflation. Is that even true in this inflationary environment?
Yeah, well, we've had other time periods. Again, we've been through 4 different economic cycles, other time periods of higher inflation, above the 2% that we've had for the last decade or so, and we've been able to beat the rents. Increase our rents above the rates of inflation. So it remains to be seen here, and depends in some measure on what the annual increases are. But in general, they've tracked inflation in our markets. So we've been able to, as I said, raise rents above the rate of inflation.
Okay, yeah, very interesting. Thanks, Neil. Phoebe, I want to come back to you. We've heard a lot of really interesting, in fact, descriptions of all sorts of asset classes throughout the day today, some of which I knew very little about and was really interested in learning. But this panel is about real estate. It's what we do. So I'd like you to talk about why real estate is an important investment and it's an asset class, and where do you think the opportunities are going to be today and for the coming year?
Thank you. So as I see the real estate for the next 2 or 3 years, the real estate investor will become more selective, that they gravitate toward strongest demand of fundamentals, which are most likely industrial warehouses for e-commerce and multifamily. And these, I believe, are the top quality asset class among the disrupted sectors. And our focus will be on funding these development asset class while still integrating the ESG components for tax equity credit, building efficiency, and improving financial modeling and valuation. The Inflation Reduction Act enacted on August 16 marked one of the country's largest investment in infrastructure and offers substantial opportunities for real estate developments. And one primary highlight of the legislation is the estimated 370 billion of new energy related tax credit over the next 10 years. The expansion, and the flexibility of the current renewable energy tax credit provide needed certainty for asset managers and developers, especially with respect to the impact and availability of these credits on future new valuation and the monetization of the tax credit through the establishment of refundability and transferability of certain credit. So also on August 9, the president also signed their CHIPS Act, which is they're creating helpful incentive to produce semiconductors act, which include an advanced manufacturing investment tax credit. And I believe this act will open doors to so many opportunities in industrial manufacturing plant development.
Yes, I agree. We can't onshore production of semiconductors quickly enough. There's a lot going on in the world right now. We don't have to necessarily get into political issues, but yes, that is a really important development that needs to be accelerated. Robert, I want to turn back to you. You had mentioned, you talked about the Sun Belt. I'd like you to expand a little bit more on why you see the Sun Belt as the best place to continue your focus, and what opportunities you see for real estate investment, let's say over the next 12 months.
That's a great question. We love the Sun Belt again because of the demographics. Just seeing people move in, and there's a lot of higher income people as well. And we have focused on the Sun Belt in particular because it's higher growth and lower cost. So I think those two combined with government that's attracting companies as well, they're moving down in droves. That again, the people need space, the companies need space, and the tenants can save on cost as well. I mean, if you're traditionally a hedge fund that's been on New York in Manhattan, you're paying $100+ rents. You can relocate to Florida. Miami has become quite expensive in its own right, but where we're focused in Central Florida is, half or a third the cost. We can deliver the same quality, better quality of life. So we try to go in and own just irreplaceable real estate that will set the standard across the markets that we're in. We bought the main passenger rail stop in downtown Orlando, which will feed into a $2 billion multimodal facility that Orlando built with high-speed rail that'll run all the way to Miami. So we love to control sort of gateway locations. We're talking with 2 pro sports teams about building facilities for them that will have office space, obviously arenas, but then office space for the teams, hotels that'll capture visitors coming to watch, apartments where people can live, retail, and additional office. So we're trying to create a sense of place where it's doesn't exist in the quality that we're trying to build. And the idea would be that it takes 2 or 3 years to develop. As the market softens, we believe and we're confident construction prices will fall a little bit. Interest rates will come back down. So our desire, is to build a really just phenomenal asset that'll hold its value over time and will set a standard. We were able to push rents in our Truist Plaza project by 20%, and we're almost doubling rents in phase 2 over what the market had achieved previously. So we're seeing a flight to quality, and we're seeing people willing to pay for it in our markets.
Yeah, I think I agree with that. I think that's true, certainly in Florida. There's just been tremendous growth here. South Florida, as you mentioned, Miami, the rents, I've never seen anything like this. I've been doing Class A office tower leasing in Miami my entire career. Rents are now double from the highest I had ever seen. So it really is, talk about contrarian markets, but the other way, and flight to quality. So it's very, very interesting time. Unfortunately, due to a pandemic, but it really has focused a lot of attention on South Florida. I want to turn back to you and to talk a little bit about interest rates, how it affects your strategy. Do you agree with Robert that they'll should be coming down in the near term? How is that changing what kind of deals you're looking at?
Excellent question. I'm not so optimistic that the rates will come down very quickly. We're preparing for rates remaining high. We are protected because we have 2,500 tenants across these 211 buildings. Their rents are adjusted by CPI, so we get all these nice bumps. Because we are investing in our buildings, we are actually increasing rents as well. And rents in our locations are 1/5 of what it would be in Manhattan. Actually, again, we're paying $90 per square foot at the Freedom Tower in Manhattan as rent. And for the same price, we buy fantastic properties outright in the Midwest. So it's a pretty amazing time. Now, having said that, in our 2 upcoming projects that we are about to get under contract, we are buying them all cash. because we are, again, we want to be risk averse. We want to prepare for the worst. Buying them all cash will protect us from anything that potentially could go wrong. And then, you know, when things normalize vis-a-vis lending, you know, be it in 2 or 3 or 4 years, we can, you know, refinance and get a significant part of our equity out. So yes, absolutely. Our strategy remains contrarian in the sense that we want to be buying at very big discounts, but the interest rates are affecting that you know, we used to use little leverage. Now we're going to start using no leverage.
Yeah, I think being able to be an all cash buyer is a really good strategy. Not everyone can do that. So if you do have that freedom, that is just wonderful, especially in this environment when we just haven't seen interest rates and inflation like this in much of our careers. I want to turn back to Phoebe to talk about implications for family office asset allocation, in particular in the industrial space. We've heard about several very, very large companies. Certainly, probably what's been in the news more than anything else is Amazon pulling back from their warehouse development, occupancy, and how the industrial world that has really, certainly since the pandemic, been a major, major wonder child of investment, and how that might be looking now for an allocation.
Thank you, Harry. So I think the slowdown of what's going on right now, the slowdown of warehouse demand comes at this very moment because our country's experience is biggest boom in industrial developments with over 700 million square feet under construction. The main problem of what's happening is the overbuilding, the big industrial development of typical size of 200,000 square feet or more. And much of the new developments is concentrated on big box facilities. Properties such as property size of over 200,000 square feet or over make up about 79% of the pipeline, compared to less than 3% of the smaller industrial facilities, average size of about 50,000 square feet. I still believe that the smaller industrial warehouses that tailor to niche small business owners, for example, e-commerce, was still in great demands, especially the size between 50,000 to 100,000 square feet. For example, one particular platform is a Ready Space platform, which is a shared warehouse-based concept that's subdividing the master industrial warehouse into a smaller suite with more flexible, practical, and economical short-term leases. And this model, I strongly believe, will be sustainable in any economy. Thank you.
I think we only have maybe 2-3 minutes left. Let me see, are there any questions here or on Zoom or anything?
Nothing on Zoom. I had a couple of questions.
Okay, yeah, go ahead. Go ahead, Marty.
Yeah, so I wanted to ask about hotel conversions to micro apartments. Are you seeing any of that? And also, any thoughts on the California laws on ADUs and if that's going to spread?
I'll repeat the question. So the first one was hotel conversions to micro unit apartments. I'll just open that up to anyone on the panel if they've come across anything like that.
Well, I think it makes a ton of sense because we've got housing issues. So to the extent that we can convert in urban areas where particularly younger people want to live, smaller units make a ton of sense. We've seen the size of apartments shrink over time anyway. So if we can provide an affordable solution, I think that's definitely coming. That will be my answer to that question.
ADUs?
ADUs?
Yeah, out here in California, ADUs, I think, are going to become more prevalent. The cities and towns are under tremendous pressure to have plans to add units, and especially in markets where there's a lot of single-family housing, ADUs is one way that these cities can add units rather than having to rezone big parts of their locations to allow multi-unit buildings. So I think that's going to be the first line of defense. But I think there's California as a state is pressuring the cities to build a lot more housing of all types, and could be ADUs, could be multi-unit buildings. So we'll have to see how that plays out, but I think there's going to be a lot more ADU type construction in California over the next few years.
And Neil, since you're the expert on workforce housing, so I guess my question is, that right now there's EDU bills that are in front of the New York House and the Massachusetts House. So my question is whether it's going to spread to a bunch of other states. I think it looks like it's going to happen in New York also, and probably Connecticut. Any thoughts on that, Neil?
Yeah, well, again, every place is under pressure to add units, and there's real resistance from the single family homeowners to rezoning big areas of the city. I mean, I'm here in San Francisco, and while we don't have any investments in the city, it's a pitched battle right now of people resisting the upzoning that's going on, and ADUs may be a compromise, if you will, and there's enough room often to add another unit on a single family home property.
Can we just address Ron Devari's question about how do you best address family offices for real estate that has operating business on top of it? Do you want to? Do you want to? Yeah.
Question.
Any thoughts on that?
You know, from a developer's stage to obviously was up and running, obviously that's always easier to get financed, but how do you get it off the ground with the good ventures?
Any thoughts on that?
Any thoughts in the panel?
I'm not sure I understand the question.
I think he's talking about instead of rather than just real estate investments straight ahead, you buy the real estate that also involves an operating business.
Okay.
And good, new concepts,
Yeah.
parks,
Yeah.
tech components, ESGs, communities, more of what to consider building for the future.
Well, I think one thing we're seeing in the office world is collaborative workspace. There are a number of companies that are growing. That's a wonderful solution for smaller tenants because of the flexibility of the leases and the ability to just pay for exactly what you need and not get locked into a longer term lease. Those companies are coming to landlords and wanting to partner with us, where we basically fund not only the TIs, but end up maybe overfunding in some instances and owning a piece of that business. So that's an indirect way that we're doing that. As landlords, I think on the retail side, maybe it's a little more common to have a restaurant concept or something that's growing where we're funding. We may develop a relationship with I did a lot of work with a family that owns Chick-fil-A, for instance. They will go and partner with other restaurant concepts and put money into the operating business and then help them with the bricks and mortar as well. I don't know if I'm answering your question.
Regarding that's, I was more thinking of ESG oriented, vertical farms.
Well,
I think that are a little bit more interested in.
I think there's family offices that are definitively ESG oriented. You just have to find them. That's really, I think people, if you have something that's along those vertical farms, there are family offices that are looking at vertical farms. Right, but I don't know if it's real estate family offices. So that's all I got. If you want to
That's all I have too. Everyone, thank you so much for staying. Again, Marty and Neeson, thank you so much. And have a great evening.